Welcome back. You're watching The Capital Point. If you're just joining us, let's keep the conversation going on Twitter. The handle is @MetropolTV Kenya. The hashtag is The Capital Point. And as we said earlier, Nairobi, if the skyline is anything to go by, is a city under construction. Now, despite that, there's been mentions of a possible bubble, but what really is the state of Kenya's real estate space and property sector as a whole? Joining me now is Dan Awendo, the CEO of Home Africa. Thank you so much for making time to be with us on the Capital Point. Now, given some of the data that we've just talked about, in terms of contribution to GDP, in terms of the housing deficit, whether you're looking at it from a residential side or a property side or a commercial side, what's your take of the real estate industry in 2019 then as we go into this conversation?
Well, 2019 was a bit of a drop, I think, compared to 2018 and 2017. The market has generally been seeing some kind of nosedive as far as growth is concerned. There are many different factors that play to that, but I think one of the key ones is just the general performance of the economy. Real estate is driven significantly by access to capital. And when access to capital is limited in any way or not flowing through in any way, that's really the first sector that gets hit, which is what I think we're experiencing over the last 2 years, and I think possibly going into the next 2 years as well.
Mm-hmm. Yeah. Speaking about accessibility, and I must say nosedive is a strong word. I didn't want to use a word like that, but it is the situation on the ground. Mm-hmm. And one of the things that, because Home Africa is of course a listed company, it's a barometer of what's happening in the space. Perhaps just using the Home Africa example, you can tell us some of the biggest challenges the industry faced from the lens of yourselves as a listed firm.
Well, I think there are a couple of major areas of concern. The first one is just access to capital. As you remember, the interest rate cap brought a significant reduction on availability of credit in the market. And obviously, if you're a developer or even if you're buying units, you have no access to new credit, which means that that space you're not getting involved. So that obviously affected quite a lot of us. We have no access to development funds, and we have no access to clients who can attract credit from the market. That affects the market completely. Mm-hmm. I think the other thing is that for as long as new units are coming and people are starting to see a reduction in price, a lot of people tend to wait and say, look, I think that the market pricing is going to come down. Let's wait a bit. So which means that while you could have had people buying units, they would prefer to hold on because they know someone else will start putting more pressure downwards on their prices. Mm-hmm. So we see a lot of wait and see scenarios. But depending on the sector or subsector that you're working in, Home Africa, for example, we saw a significant growth in our turnover. I think we managed something like 11% on our top line, which I think is a big difference compared to what the rest of the market has been experiencing. Most of the market has experienced a downward trend as regards the growth on their turnover. But also it's because of the type of product we are working with. We see some of the smart plot projects that we're doing working out quite well. We also see our mega residential units picking up new clients, whether they're buying already existing houses within the facility, or they're buying parcels that they can then develop by themselves. So to us as Home Africa, we saw growth, but the market generally has had a bit of difficulty. Mm-hmm. Yeah.
Let's talk about the access to capital for a bit, and that's both from the retail side and the developer side as well. Mm-hmm. And looking at reports drawn last year in 2018, whether it's contribution to GDP, and one of the main reasons they said, and as you have alluded to, was the access to capital. Mm-hmm. But when we come down to the basics, and the Mwananchi says, I do have some money, but then mortgages are so expensive. Mm-hmm. Will the rate cap or the lifting of the rate cap, do you see that having an effect in, say, 2020?
Personally, I don't think it's going to be a significant effect, and I'll tell you why. And I know there are people out there who might disagree with me, but this is my view. During the rate cap period, the banks found themselves in a place where they really needed to scale up their efficiency, really needed to scale up their investment into IT, so that they can still maintain profitability, albeit the lower interest rate. So through that period, they proved that it was possible to actually create a very well-run, very efficient bank, and therefore still generate good profits without taking too much risk, but also being a lot more efficient in the way they run the operation.
So it was a double-edged sword in a way.
Yes. So on this side, now that the rate cap has moved, I still don't see any reason why a bank would take any further risk than they would otherwise take. I don't see a bank that would say, oh, now we can be a little careless, because I don't think that's going to be possible. I think that they will continue to increase efficiency in the way they do credit process and credit rating and all of that, to the point that the expected hype or expected levels of credit in the market that we all are thinking is going to to shower the market, I don't think it will be like that. Over time, maybe, as maybe they take more appetite as far as credit is concerned, but not immediate. I don't think it's going to be immediate. And so we see, my personal view is that I think we will see a very, very slow growth in the increase in the size of credit in the market.
All right. And from the mortgage perspective, and it's a fact that in Kenya today, most of the people who own their homes bought it in cash, mostly from the SACCO side and not the banks. I think the current rate is 90% SACCOs or 95% SACCOs and the rest banks, at least from the very retail perspective. How do you see that panning out going forward? Will people still take their credit for housing mostly from the SACCO side, or will banks begin to warm up?
Well, we are at about 28,000 mortgages in the market through the period when interest rates were at their 24%, even through the period when interest rate had come down to 13%. Is there any reason why it should move significantly from 27,000 compared to what it really should be? I don't see it. So my expectation is that the SACCOs and the short-term loans and the personal loans will continue to fuel development of individual retail houses as opposed to mortgages. Getting mortgages in Kenya is very, very, very difficult. Most of the 27,000 in any case are bankers themselves. Not even the open market. And so it's not going to be any easier for people to access that mortgage. Interest rates are still, I think, quite high. The terms, by the time you get yourself a mortgage, you're possibly 20-30% down as far as the investment is concerned of the value of a property because of charges, legal fee, valuations, and all of that. Makes it very difficult for normal, low-income, middle-income person to take a normal mortgage. So I don't see that's moving. But I see a situation where, as we go into people buying plots, because that has been the Kenyan thing, people prefer to do that because then you can take a loan of 100,000, start a kitchen, another 200,000, build your sitting room, and so on and so forth. So you're doing it at an affordable level, and you can be able to do it at your pace. I see that continuing to be the process of how people own their own homes.
So what does that mean then for larger properties, where ideally you'd go for, directly to the bank? What do you see in terms of, are we going to see new models of financing bigger development projects?
I think so. Two things are going to start coming, I think, quite strong in the market. The first thing is that vendor financing is going to pick up, because we realize that while you've gotten development finance from financial institutions and so on, if you're not getting your customers to buy your units, you have to find a mechanism through which you can finance them over time. So, and we see that fueling our sales, for example. So you give them 12-month payment plans, 4-year, 5 years. We've now seen 8-year, 12-year at zero interest rates. That's a market that is already showcasing that the vendor can find ways of financing the buyer. So that's one. I think that the tenant purchase schemes will also start getting a lot more attention in the market, because tenant purchase is the same model where you're creating affordability for the buyer over a period of time to pay rent, but at the same time own the unit. Now that's going to work significantly. In other markets, that's the biggest way of owning units. We've still not seen it here. It has worked before in some developments, but I think it's going to pick up a lot of pace. Yeah.
You've mentioned affordability, and that takes me back to the number of the housing deficit. There's numbers that are bandied around about how many are required a year. I think 200,000 currently. We are currently at about 30,000 per year. And I'm just wondering, when you look at that affordable space, what is really affordable?
You see, at the end of the day, I don't think it is a quantum amount value of the house, because most people will not access the quantum amount, whether it's 2 million or 3 million or 4 million. Most people will not afford that quantum, but people will afford quantum from a monthly payment perspective. And that's why you find that in the Gikomba market, for example, credit that is given so that people can pay on a weekly basis is very big, because you can afford based on your daily cash flow, based on your weekly cash flow. Same thing with mortgages. When we go to the place where from your 50,000 shilling net income, you know that 15,000 shillings is going to pay your mortgage, it becomes affordable because it's within the liquidity levels that you're paying. That's, to me, is affordability. But when you say 3 million, first of all, no one will have access to that 3 million, not many people rather. But you have to then give people time to pay the 3 million. If you give them enough time, they will certainly afford the 3 million shillings.
What opportunities do you see in that space, in the affordable and low-cost housing space?
Specialized mortgage facilities or structured mortgage facilities. We have a situation where our banking sector has been structured and arranged and organized around commercial, around manufacturing and other sectors, but not around mortgages. So if you look at our banking sector, not very few banks can say we are experts or we are well known for mortgages, except the old names like housing finance and so on. We don't have them.
Yeah, actually I read a report, I think by the World Bank, that said only 6 out of the 44 banks currently have real good mortgage finance products.
And yet, in other markets, we have specialized mortgage institutions which provide specialized structured mortgages for the buying market. Now you need that because the type of funding that they require is very different from the type of funding that our banking system has. The type of terms that they offer is very different from what the normal banking system has. And those are the ones that need to be developed so that we can then fuel the uptake of property in the market.
Technology, how do you see that playing a role, especially within the affordable space? We're seeing an influx of new, technology that is cheaper, that is said to even last longer than what we currently have. How do you see that shaping up in the near future?
I personally think that that's going to be a good space to engage. Remember, at the end of the day, whether it's for mortgages or for other types of financing, cost of credit has never been the problem. It's been the access to credit that is the big problem. Those mobile-based lending have extremely expensive interest rates, not just outside the banking sector, but even within the banking sector. Now, we now see a situation where, as you now go into products like mortgages, even when it's a little bit more expensive, it will be at an affordable rate for the person who is investing. And those will therefore be popular going forward. And I think technology will play that role, that yes, I might be able to offer you a mortgage facility over a long period of time. It's expensive, but it's affordable based on the liquidity that you have access to. Yes.
How about sustainability? It's becoming quite a big conversation on the global platforms. And we're seeing a lot of real estate capital now looking towards Africa. And of course, sustainability is a big component of where that comes in with urbanization and all of that. And I'm just curious about your thoughts on sustainability within real estate. Are we there yet? Are we getting there? Are we thinking of it?
I think so, particularly now as we start moving towards much more environmental friendly type of products. I've just seen a green bond now being issued, accessing credit specifically focusing on product that is going to be green. Now I think that's the way to go because it has a lot more affinity towards attracting capital. But also I think that as we move more into value addition of our product, therein lies sustainability, because if I'm doing a master planned facility, for example, I must then take responsibility to make sure that the community is sustainable, not just from use perspective, but also from an environmental perspective. And I think that's going to be critical, because I think that there is profit also within that space. Yes.
One of the trends that has been talked about recently, at least 2019, was collaboration within the real estate space, especially with government, PPPs or big asset funds or coming in from abroad. And I'm just looking at what do we expect to see in that space in as far as co-developing projects with government or private equity or finances from abroad.
Let me say in the near term, we're still going to see a bit of a lull. I note that there are few interested parties who are now starting to get involved. People out of the UK, out of Europe generally, out of America, who are now looking at that space and saying there's opportunity. But I think there are a few more things to be done, especially where de-risking some of our projects is concerned. De-risking here, I mean, just sorting out the issue of construction permits. That shouldn't take you 2 years to access. Sorting out the issue of getting approvals for your development, getting approvals for your completed units that still take you 1 year, 1.5 years to access. Those are the things that keep international investors away, because they really have no control over that, then they don't know what to do with that. So what will happen is that collaboration will come into play, because the local company has been able to take a project, de-risked it from all these vagaries that have created limitation for the international partners. So by the time the international partners come, you find a project that can move quite quickly without being limited by all these things that had been created before. So that collaboration, I think, in the medium term going forward will happen, but only as government removes the bottlenecks that keeps developers, constrained over long periods of time, sorting out with counties and so on and so forth. Yeah.
One of the things that we hear about, especially on Twitter and the social media streets, as they're referred to, is that driving down Nairobi, it's Kilimani, Kileleshwa, there's a lot of empty houses.
Yes.
PwC had predicted about, I think, 2 years ago that there would be an oversupply on the commercial property side. What are your, where do you see that currently?
Well, that's a fact. When you think about commercial, I think today we probably have somewhere around 5 million square foot of space that is available, that has come into the market, that has no takers. Same thing with the retail. Retail, we're talking about malls and so on. I think we have another maybe 2-3 million square foot of office of retail space available that is not being taken up. So that has forced, obviously, existing facilities to bring their price down significantly to be able to attract retailers and so on and so forth. And that's, I think, partly what is driving a lot of the international players to come and look into this market and say, oh, we have cheap space that is available and that we can be able to create a product in there. But I think that there are certain sectors that still have big demand, the affordable housing space and maybe some part of low to medium income space. But middle income, where you're talking about Kilimani, Kileleshwa, I think we have a problem. I think there's significant market correction happening there. I wouldn't call it a bubble, but significant market correction. Rents are coming down, house values are coming down, and at least over the last 2 years, that has happened, continuously. And I think it will still go on for a short while.
There seems to be a trend towards student housing or student development, and
Yes.
some of that is against the backbone of Africa's largest population being within the age group where they will be probably in the universities and colleges. Is that something that you're looking at as Home Africa?
Yes. At the end of the day, the population at that space is huge. Our universities created universities but never created the facilities to accommodate the students. And so all universities are suffering the same problem. So there's significant opportunity there. So the early takers in that space have taken advantage, and they will continue to for as long as the players have not really picked up. But yes, there's huge opportunity there that we also see, and hopefully down the road we'll also get involved.
All right.
Yes.
Other developments that seem to be picking up is the the lights of the community type, where there's a supermarket, there's a small school, there's a playground, there's all these things. How do you see that panning out, given that some of the trends that were released by Haas last year showed that it's the semi-detached and the detached that seemed to have an upward trend in as far as uptake in 2019?
We call it lifestyle developments, where you incorporate everything that a human being requires within the same environment. So it's hospitals, it's entertainment areas, it's sports facilities and so on, which is similar to what we are doing in MIGA. So in MIGA, the idea is to provide all those amenities for a family so that they don't really have to come out of that environment to go and seek for other types of amenities. Those are picking up. You have to be very careful what sort of common amenities you provide. I think a lot of us went into the golf side. Others, I think, should be able to go to other areas. I see Tatu City also went into industrial, probably will expand into other areas. But I think there's opportunity in that space because families, particularly this growing middle class, are looking for a place where they can be secure and families can be secure. They have a good product, good environment, and can enjoy their lives without having to go out of the facility. And I think that trend will continue. Yes.
What's the uptake so far for MIGA, and how do you see that, especially, even though you did say that the repealing of the interest rate cap will not make such a big difference, what do you see the uptake of MIGA being in 2020, and perhaps with that just an outlook through, of course, the lens of Home Africa on your expectation on that space in this year?
I think our uptake has continued to grow. That's the most interesting things. We think that part of the reason we have a very different, unique kind of product. First of all, we are only 23 kilometers away from CBD, so which means we are the closest golf estate within the environs of Nairobi. So if people want to live on a golf estate and still work in Nairobi, MIGA is your closest compared to anybody else. Secondly, we have become quite creative with payment models, because we know affordability is a key part of how people buy your product. So we've tried to be very, very creative on how people pay and how we allow people to access the facilities, maybe even start building while we are still receiving payments from them. And that has helped us with a lot of the uptake. We see that continuing. We see us continue to spend our time thinking creatively on how to make sure that people still come and buy, and we offer them facilities that can help them to pay in affordable units. Yeah.
As we wind up, your outlook for 2020 in real estate?
I'm positive. Remember that we did better than at least Home Africa did a little better than we did the year before. So I'm quite positive that the trend will continue. I know the market has sort of stagnated to a large extent. A lot of market correction is happening, especially in the middle income space, commercial and retail. But I think that if you take a good niche on your product, if you offer good payment terms or creative payment terms, I think you'll still do well.
Right.
So while we know that the market is tough, particularly in our industry, we think that the credit will not be as much as everybody is thinking. I think it's about creativity from our part to make ours work, and that's what we are focusing on.
All right. Thank you so much for making it on the Capital Point tonight.
I appreciate it.
We've been speaking with Dan Awendo, the CEO of Home Africa, and you have been watching the Capital Point. Thank you so much for keeping us company. Until next Wednesday, let's keep talking business.